So hi everyone, this is Finance Meets Real Estate. So as you guys know, we meet here every Tuesday. We have amazing guests every week. We've hosted over 100 people so far. So we have today David and Amanda Fornelli. So I'm very happy to have them on. So they're going to talk about how they scaled basically short-term rentals business essentially within like just a couple of years. It's a very, very interesting field. At least I would think kind of like a mix of a business, like a regular business with real estate, if you will. So Amanda is from LA, from Los Angeles. So she has background in engineering with an MBA. She used to work in corporate America and, had her career there. And David, also LA native. So he's now they're now based out of Joshua Tree in California. And so he used to work as an archaeologist after earning his master's degree. And so they're co-founders of Nopali Properties. And so they do short-term rentals. And so I'm very interesting to hear what they will share with us today. So with that, I'm sure you guys can speak a little bit about yourself as well, like how you got into real estate, how you got into short-term rentals, and what are your next steps, where you're trying to get to yourself, and so forth. So with that, I'm going to pass it on to you. And if anyone has any questions, feel free to speak up, and we are going to do also Q&A at the end.
Yeah, definitely happy to answer any questions that anyone has. The short-term rental space, it's a really exciting space, and I think you said it great, Stefan. It's the marriage of real estate and a business, right? And we'll get into it later on about, I think that's why we became successful in this industry, because we treated short-term rentals like a business and not just like, some side hobby. But before we get into all that stuff, I want to give us some provide some backstory. So Amanda, you want to go first? Because her story is really cool.
Yeah. Well, Stefan, thank you so much for the opportunity to be on this podcast. We're so grateful. You touched a little bit on our individual backgrounds. I want to start off by saying we have a third business partner, which shout out to him. He's also my brother. His name is Oscar Bustos, a really fantastic part of the team. He has a background in commercial construction. So all three of us came together in late 2019 to form our company, our real estate investment company. And since then, we've been investing mostly in fix and flip projects, which led us down the short-term rental path. So we started off as fix and flip investors, got into the short-term rental space, and now moving forward are getting really, really deep in that space, becoming true experts in the short-term rental space, now also venturing into the commercial world as well. Did you want to add to that?
No, that was great. That was great. I think a big thing that I just want to note is part of the reason why we got into real estate to begin with is because Amanda was actually let go from her W-2 job. So like you mentioned, Stefan, both of us, we both have master's degree. We're both educated. We both have W-2s. And we were finding that it still just wasn't enough, despite us doing everything that we were told to do. Go to school, get a good job, get a W-2, right? Like we still found ourselves in debt and we still found ourselves without a home. And it wasn't until Amanda actually got laid off from her corporate job that we started really kind of looking into what else is out there. And that's how we came across real estate. And we haven't looked back since. It's been absolutely wonderful.
So that sounds amazing. So you mentioned you guys started as essentially like fix and flip. So investors, I think, and we had a prior conversation with you, like where you mentioned like the BRRR method. And so how are you mixing that with your current like short-term rental strategy? Is that an important component, or are you more focusing like on the revenue side of your business?
Yeah, that's a great question. So as we mentioned, we started off with fix and flip, right? And we started off, we're based out of Los Angeles. And at the time, this was the end of 2019, early 2020. It was a very, very competitive market. And so we were struggling because we wanted to flip a house, but, lenders wouldn't talk to us. Realtors wouldn't talk to us. Like it was difficult just getting our feet off the ground. So Amanda had this incredible idea to just send out an email newsletter and just see what happens and let our network know, hey, we're looking to flip a house, right? So she sent out an email newsletter to her network. and an old coworker responded, and that coworker had a home for sale in Joshua Tree, California. That was about 2.5 hours away from where we were at the time. But we thought, hey, you know what? We really want to make something happen. So let's go for it. So we ended up taking on the deal, seller financing. It was incredible. And we actually invested in that project out of Amanda's IRA funds at the time. So it was our own money, right? And we purchased the house for 210. I'm sorry, we purchased it for 205. And as we were flipping it, we started seeing this short-term rental market, this Airbnb market in the area in Joshua Tree was just taking off. And being flippers, we were very keen to the market. We always had our eye on what was going on, what properties are doing, what were they selling for. And we were just getting blown away constantly. The appreciation was just out of this world, right? And so that got us thinking like, hey, maybe there's something to this short-term rental game. Like, I know we want to flip houses, but how do we get a short-term rental? Like, can we have a short-term rental for ourselves? So we ended up kind of flipping the house into a short-term rental. We bought it, we sold it for double what we bought it for. So it was an absolute home run. And that got us really thinking, Stefan. That was like the first time we were like, wait, what's going on here? I know we're so new, we're such rookie investors, but how can we work to really keep these houses for Airbnbs? And so we did a couple of more flips. And again, the Airbnb market, the short-term rental market was just taking off. And it was entirely hard to ignore. There was just no way we could ignore it at the time.
Yeah. And just to add to that, there were two really critical strategies that we implemented to grow and scale our business that have been really like an integral part of our growth. So one of those was, you mentioned the BRRRR method, right? So for those that don't know, you buy a property, you renovate it, to force appreciation, you rent it out, you refinance, right? And then you maybe, if you do things right, you cash out some of those funds and you go put them to work elsewhere. So the BRRRR method is very powerful, and it's also extremely applicable to the short-term rental space as well. So this is something that we developed over the last couple of years and started to refine in our process and get really good at, because that creates the most value for us. That allows us to, get into these properties with very, very little cash in the deal. The second strategy that was super powerful for us was other people's money, the use of OPM. So we utilize private money a lot. So private money is, we're not with hard money lenders or private equity. It's private individuals like you and I to fund these deals. So that has been really instrumental for us to scale quickly without any limitations on the access to capital. So between those two strategies, we've been able to scale to 14 doors at this point. And we continue to plan to use those strategies moving forward.
Yeah, we like to call it a modified, the BRRR strategy, the BRRRR strategy, as they call it. We like to modify it and we call it the burster. It was a term coined by Rob Abasolo, the Bigger Pockets podcast host. And basically it's burring properties and then keeping them as short-term rentals. And I listened to the podcast that you did with Nelson, and you guys actually chatted a little bit about the BRRRR strategy and this idea of infinite returns. So once we were turned on to infinite returns, we were just like our minds were literally blown. I was like, what the heck? Why doesn't everybody do this?
Yeah, right. Mm-hmm. No, it's a great strategy, and you have like very strong revenue afterwards at the end. So it's definitely it's a good way to go about it. And in terms of like the markets that you guys are in, so I know you are in Joshua Tree. So is that where you focus exclusively, or are you looking for any other kind of more exotic locations relative to your, your place of living, so to say?
Yeah, happy to answer that. So we started off, we did a little bit of work in Los Angeles. We also ended up by chance in the Joshua Tree area, which is high desert of California. And we found, again, that David alluded to it earlier, we were just watching this market unfold and we wanted to participate. So we decided to spend a lot of time in this market and did a lot of work out here. So that's historically where we've been. Joshua Tree is an extremely strong vacation rental market due to its proximity to the national park. It's also a 2-hour drive from a metro city like Los Angeles. So it was a big part of our strategy for a long time. We have 4 active short-term rentals there. We just acquired a 10-unit boutique hotel in Palm Springs that will be launching very, very soon. It will be sort of a hybrid model, short-term rental and hotel. So now we're invested in the low desert. But moving forward, we're actually now looking at markets out of state, mostly in the Western United States, and looking at key markets strictly based on data. Like, where is the data showing? Where is the data taking us? What is it showing us as to where would be the most ideal market to invest in next? That's out of state, perhaps at a lower purchase price, right? Or lower purchase price and maybe a lesser of investment, but with still really strong returns. So we are looking out of state next.
Yeah, and really, Stefan, like our bread and butter, our kind of niche is these what are referred to as drive-to vacation markets. So I'm not sure how familiar you are or your audience is with short-term rentals, but Avery Carl, she's a realtor out of the Tennessee area. She literally wrote the book on short-term rentals. It's called short-term rentals, long-term wealth, or something like that. It's a Bigger Pockets publication, and she's brilliant because she breaks it down into 3 ways that I think are really digestible and easy to understand. There's really for short-term rentals, there's 3 main market types. There's a metro market, right? So your city markets, downtown Houston, Las Vegas, Nevada, New York City. Well, maybe not New York anymore because regulations are changing, but these big cities, right? A metro market where the draw is often things like maybe sporting events, concerts, golf tournaments, things like that, right? So you have your metro markets, then you have your drive-to vacation markets, which are vacation markets that are close to a major city where people can drive to 2 to 3 hours away, right? And then you have your fly-to vacation markets. Is our opinion, we just happen to really, really like these drive-to vacation destinations because, one, they're typically robust short-term rental markets in that short-term rentals are already well established in the area, right? So if short-term rentals are already well established in the area, then generally regulations are going to be favorable towards short-term rentals in that area, and they're not going to change. A really horrible thing would be if you were to invest in this area, you have this amazing property, put all this money into it, and then all of a sudden the regulations change and you can't even operate a short-term rental. So that's why we like this drive-to vacation market strategy. Like I said, 2 to 3 hours away from a major city, something that has a lot of recreation or vacation or just a big draw. And that could be different for each market, right? There are places in the South where something like a speedway is the big draw because NASCAR comes and everyone wants to go and watch NASCAR in that city. And then there's places like where we live where there's a national park, and that's the big draw, happens to be the national park. So again, for us, it's just a way of investing in a market that's already robust and will prevent or hopefully prevent regulations from changing on us.
Mm-hmm. And you mentioned kind of like looking for like, let's say, relatively low price points and kind of like and high, perhaps like Airbnb revenue and so forth. So what tools do you guys use to do that? Like, how do you find those? Is it, I guess, AirDNA and then like kind of like their usual like housing, like Zillow, etc., or is there like a tool that combines those for you? Or I'm not sure. Mm-hmm.
All right. Yeah, I can jump in here. So we use a couple of tools, and there's so many tools out there. There's a plethora of all types of tools, and we try to narrow it down so we're not overwhelmed with data. But AirDNA is, I think, one of the most reliable and most accepted across the country as far as data goes. The other one that I started using is STR Insights. It's a newer tool. STR Insights we use as more of a market level approach when you're first starting off your research. You don't know what market to invest in. This is a great place to start. And then AirDNA can get a lot more granular with the property. But generally, what I like about STR Insights, one thing that we look at as a really interesting metric is something that they also use called gross ROI. And the gross ROI is pretty much the average annual revenue for that market divided by the median, not the median sales price, but actually the valuation of Airbnbs in those areas. So
the actual property valuation, right?
Yeah, so they take all of these short-term rental properties in the area, they send them to a third-party appraisal company, and they give general valuations on those. So now you're almost looking at, it's really like, what's the bang for your buck, right? What is the gross ROI for that specific type of property that's operated as a short-term rental. And it's a very like straightforward, easy metric to start with, because once you're looking at a gross ROI of, I would say 10% or more, then you can start to really look at that market more closely.
Right. And then the other big website is obviously Airbnb, because that's where the competitors are located, you know. And then this is strictly speaking in terms of like the analysis, the underwriting side, right? There are other tools. We just happen to use AirDNA and STR Insights. That's why we like talking about them. But in the past, we've also used Price Labs. There's another tool called Mashvisor that are all pretty good. And generally, these are all kind of industry standards. And this is, again, for underwriting, for the analysis portion. Now, in terms of like the operation and running it and property management, there's a whole another, what we like to call in the industry, tech stack or technology stack, right? Of different properties, or I'm sorry, different softwares we use to manage the property softwares for the cleaners, software for dynamic pricing, software for our systems, right? There's a software for everything, a software to monitor the noise in your short-term rental to make sure that your guests aren't having a party, right? So one thing that's really, really cool about the short-term rental industry is this kind of fusion with technology and softwares, and kind of using that to our advantage to make sure, one, our underwriting is sound, and then two, when we actually close on the property, we can manage it efficiently, you know, remotely as well. Everything is on Wi-Fi now, so it's absolutely incredible to run it. So really the software is two phases. Like I said, it's on the front end for the analysis, and then the back end for actually running the property.
Mm-hmm. And so AirDNA, let's say, how reliable have you guys found it in terms of, you know, gauging, let's say, a new market for the actual like demand and like, you know, whichever like nightly rates there and so forth? Is it something you can rely on since it's pushed directly from Airbnb, or?
Yeah, it's funny you asked, because just before this call, a friend asked me how reliable is AirDNA, and you know, every tool is only as powerful as the user behind it. So you need to make certain inferences or assumptions about the data that you're receiving and modify it to your specific deal. So you can look at AirDNA and it can tell you some sort of like market metrics, occupancy, ADR, revenue, but it is up to you to really look at it in a more granular manner. So what I mean by that is, you know, properties, you know, this is also another reason why we use STR Insights. Like you can have properties that vary so much in performance, properties that are at the 50th percentile, and then properties that are at the 90th percentile. The spread on those numbers is so wide. So it's really hard to just take an average from a market without doing a little bit more research. So I actually, you know, when we run these numbers, we run a comparables analysis. We'll pick out a handful of very similar properties with similar amenities and features, guest count and all that as our property. And then we look at the data for those comparables, because that's going to give us a lot more accuracy on how our property can perform. We generally like to compete in the 80th percentile or better for all markets.
Yeah, and when we're selecting the comps, I mean, you could get lost in the weeds, right? You can look at a million different properties and then you're going to confuse yourself. So when you select your comps, right, like pick 5, you know, maybe 10 max comps that you feel are really strong comparables to your property in terms of amenities, size, right? Very similar to when we're comping properties for a flip, for a sale. You actually want to look, what's my competition doing? How can I do it a little bit better than them? How can I stand out? Right. So like that's why I said, really try to pick 5 to 10 kind of key properties when you're doing your analysis.
Mm-hmm. And so you mentioned like purchasing a 10 units, essentially hotel, right? Like, so what has been your experience with that, and what is the strategy there now? In that scenario, you improve the net operating income, try to raise the value of the property on one side, so that mixed with purely the cash flow itself. But what has been your experience? On the other hand, it's a pretty different product, I assume, being like 10 units versus single family residence. I'm not sure if it's as easy to rank in the 80th percentile of Airbnb in that case, right? Because now it's harder to make it such a unique property. So I've done Airbnb in the past myself by New York City. So, and I remember, and I had like 5 units, and I had one of the units was doing incredibly well, but the other ones were doing extremely mediocre. So they were just basically doing as much as like a regular rental would do. So then I felt, oh, that was so much work. It was kind of a waste of time to set them all up, because I wasn't doing any better, you know, it was just more work. But the one unit though was doing incredible indeed. But again, it had like its unique, kind of more unique setup than them, and kind of unique characteristics, and was more marketable respectively. So perhaps that one was something like 80th percentile and above. So therefore doing well. But again, like, I'm just curious how that works, especially when you mix it with commercial and once it's an actual hotel, because then some of the uniqueness and charm then disappears. And I know that's somewhat of a short-term rental appeal usually.
Yeah. So we purchased a boutique hotel. So it's a 10-unit
Okay.
boutique hotel. So in that sense, it's a little bit closer towards a short-term rental kind of Airbnb. We felt a little bit more comfortable knowing the short-term rental space and knowing we were taking on a 10-unit boutique hotel as opposed to like an 80 key or 80 door, you know, Holiday Inn renovation or
Right.
something like that, right? So we haven't gone officially live with the hotel just yet. We're planning to go live hopefully next month, so very, very soon. Just in terms of the analysis and everything, you were talking about this with the podcast on Nelson. I thought it was pretty interesting. So there's this false idea, right, that just because we're purchasing 100 doors or a $5 million purchase, that our returns are going to be, you know, better than something like a lower purchase. But what we found so far is that the same amount of work that we put into underwriting a single family home goes into underwriting the hotel. The same amount of effort it takes really to put thought into the design, the renovation, making sure that the experience is cohesive, right? For every guest who stays there. It's been pretty much the same amount of work, but on the bright side, we're going to have far greater returns because just the potential that the 10 units can do as opposed to having a single rental unit. So from that standpoint, even though we haven't launched, it's already been amazing.
Yeah, and just to add to that, you know, on the actual business model, so it's in a really great location. It's in downtown Palm Springs. It's near all of the other like really reputable hotels and all of the great landmarks. So we've been kind of running the model in a couple of ways, and I think what we're heading towards is something very hybrid. So we will be offering nightly rentals for single rooms, right? Maybe during the lower times of the week or perhaps in low season. But we will also offer a full buyout model. So the really cool thing about this property, and this is where I think there's a big void in the market, and I think this is why this type of strategy is becoming more and more popular, is more and more larger groups are looking for places to stay together. So our property will provide an experience and a full buyout option for 26 people in those 10 rooms, and they have access to the entire property to themselves. So the courtyard, the pool, the clubhouse, all of its amenities just for your party. So we're finding that some competition in the area are doing very well with that model. And we happen to offer one of the higher occupancies in the area. So we'll be operating with both, you know, the hybrid model and just kind of testing it out to see what works best. But, you know, really the projections look really strong, especially for this really great market that continues to grow and grow in popularity and in tourism.
Yeah. And, you know, the cool thing, Stefan, is the hotel is commercially zoned, right? The short-term rental ordinances apply to single-family residential. So because we purchase a commercial property, we're not governed by the same short-term rental regulations as a traditional single-family home. So it's pretty cool because it's kind of a little bit of a workaround in the area that I'm not sure if maybe regulations are not going to catch up, or maybe they just haven't caught wind of it, that people are kind of doing this with boutique hotels. But it's a very, very kind of useful strategy for us because we're operating a short-term rental in a market where, again, traditionally for single family homes, the short-term rentals are banned. So it's pretty cool.
Right. No, that's great. That's definitely safer, right? In that regard. And so we have a question in the chat from Taiwan. So he's asking, how are you guys structuring partnerships for the purchases, or are you purchasing independently? So let's say on the 10 unit specifically, if you want to go into that a bit.
Yeah, I will start off by saying that most partnerships, I would say all partnerships, are unique in their structure. And that's the beauty of it. You can structure it in any way you want. You really have to assess what are the strengths of each of the partners, what value are they bringing to the deal, and then you assign that value or that contribution some sort of equity percentage, right? So in this case, it was a really awesome partnership because we actually, our team, which is Oscar, David, and I, partnered with another couple actually to take down this hotel. And what we agreed on is we would take on some of the equity to manage the entire design and construction portion, which has been over the last few months. And our business partners they know a lot on the operations side, property management. They're great at marketing. So it was a really beautiful partnership in that we're both bringing a lot of really great aspects to the deal that's going to make the property perform well. So we structured it in a way where we're doing, for some of that equity, we're actually doing the upfront work. Then once it's ready for operation, we'll pass it off to our business partners to take on the rest. But again, it depends on the partners. It depends on what they're contributing, to assign it a value and figure out a way to distribute the equity that is, equitable and really reasonable for everybody involved.
Right. That makes a lot of sense. And so Michael is actually mentioning, with regards to tax advantages of Airbnb, immediately expensing, let's say, in year one. So I'm not sure your experience with that, since I know you mentioned you kind of transitioned from your job earlier. So in that sense, like one of the big advantages, at least that I've kind of overheard of Airbnb, is, okay, it's an active income and you can kind of offset active income against your other active income, such as the W-2 and so forth, which you can typically would not be able to do with passive real estate rentals, unless you are a real estate, quote unquote, real estate professional tax designation. So that's a pretty great strategy, where you can have like a W-2, the person with a W-2, he purchases an Airbnb, does a cost seg on that Airbnb, and then kind of like deducts the depreciation in year one, and offsets significant taxable income from his W-2. Is that something you guys have experience with, or anyone in your circles perhaps?
Yeah, there are so many tax advantages to this asset class, and we're not CPAs, right? You want to consult with your CPAs, right. But we obviously, we don't have W-2, so it's a little bit of a different approach for us. We are full-time real estate professionals, right. But I know of people who are doing short-term rentals in addition to their W-2s, who are seeing huge advantages. I have a friend who I was talking to today. She's on a W-2. She makes really great money. And for the first time, she's getting like a really big return because she invested in a short-term rental. So, you talked about a couple of things, right? You can offset a lot of that income against your W-2, but you're also looking at things like bonus depreciation, cost segregation studies, which are becoming so popular and a lot more attainable, right? These are really great ways to just decrease your taxable income. And then also you're getting appreciation on that asset. And if you do the numbers correctly, you'll also get that cash flow. So it's a really incredible way, to offset your income. And I would recommend strategizing with your CPAs before you acquire a rental, and to pretty much get the most efficient use of that tax deduction.
I will say, though, from what I've seen and talking to other individuals, it can be a bit of a double-edged sword. And let me explain. So I think a lot of people heard or were turned on to the idea of the cost savings, or tax savings, through short-term rentals. So they went in there and they purchased a short-term rental without maybe underwriting it the way they should have, or really doing the necessary diligence to make sure that that short-term rental was going to perform the way that they wanted it to perform, in addition to getting all of those tax strategies. So I've talked to tax savings. So I talked to a couple of people, like I said, and they're purchasing short-term rentals from individuals who are in this exact situation. They heard of the tax savings that can be had through acquiring short-term rentals. They thought, great, maybe they didn't do their diligence the way they should have, and now they're underwater, or they're finding, oh my gosh, this short-term rental is so much more work than I thought. I want to really emphasize how much work operating a short-term rental is. It's very different than just signing a lease with someone and then getting a long-term tenant in there and then having maybe someone manage it, or paying your friend to just handle the communication. Short-term rentals are a crazy amount of work. So it's great, and it's a great way to offset your income, but just really make sure that you're buying a strong deal and you're buying a cash flowing deal in addition to all of those amazing tax savings that you get.
And that's assuming you want cash flow. Some people buy properties for different reasons, right? But most people do short-term rentals for the cash flow because of the amount of work that goes into it. But, there are a lot of really wonderful advantages. Just definitely recommend strategizing with your CPA before you make a purchase.
Mm-hmm. I always felt like, so when I did it in my simple form that I did it, my experience was, okay, if you have like a rental, you have to kind of deal with, okay, let's say you manage the building, now you manage the units, but now you have let's say an Airbnb, and now you're also managing like the belongings within those units, right? It's like way more. So now you have to manage, there's like forks that have to be in the kitchen and all those little things, like plants and so forth. And so that was like, I felt like that's kind of like another ball game where you need to really, kind of really work a lot, or have your systems in place to handle it. But then another thing I'm curious about, so is perhaps if the economy may be potentially slowing down, not yet so much, but let's say in that regard, like, are you having any maybe like analysis for like how, because typically like the hoteling industry like a certain performance if we enter a kind of a little bit of a turn in the market. So usually like commercial real estate, like hospitality investors, I know they adjust their loan to values when they purchase in that. Is that something you guys are thinking about, or perhaps adding more reserves instead of adjusting LTV, or like what is your specific approach? And also, like, another thing, I know there's an article that came out a couple of weeks ago when the Super Bowl was actually, with regards to like this, maybe you guys saw it, like this Phoenix, like basically an operator of like 95 Airbnbs in Phoenix, where they said that, okay, the Super Bowl, day or whatever, they actually had only about 50% occupancy. So which seems like quite unusual compared to prior years. I'm not sure what was the cause of that. So I'm just trying to understand, like, what are your thoughts in terms of like staying protected from like bigger macroeconomic conditions, or like bigger swings in demand in specific markets and so forth?
Yeah, just some initial thoughts. Again, I touched on the 3 different types of short-term rental markets people can invest in.
Yes.
And I think that's a good reason why we like the drive to vacation markets, is because in recessions, you're right, people do tend to pull back on spending. They don't travel as much, right? But if you are going to travel, are you going to want to get in a plane and book a trip to Hawaii? Or maybe you get in the car and you pack your family and you drive 2 hours to the national park. So that's something that we kind of thought ahead of time, kind of forecasting out for a recession. They're cyclical. We knew it was going to happen, right? They always come. It's no surprise. The other thing is, when you look at kind of historical data, and I'm not an economist, right? I'm just recently really immersing myself and becoming obsessed with these larger macroeconomic trends like you're talking about. But when we look at the history of recessions, a recession really hasn't lasted longer than maybe a year, right? Maybe 13, maybe 14 months maximum, right? So as long as we can weather that storm with building our reserves, right? Making sure we have enough reserves to get us by, just in case, worst case scenario, just in case we had to get by, then that's something that we're actively doing right now, is just putting a little bit more away into reserves rather than putting that or distributing it to us as cash flow.
Yeah. And to add to that, on the market side, right, we talked specifically about the property and hedge against any sort of changes in the market, but specific to the market, one thing that we're looking at as we're going into out-of-state markets as well, is things like population growth, right? Is there a decline? Is there a mass exodus of people? If there is, why? Maybe that's a red flag, right? We know investors who don't even touch markets where there's any decline in population in that area. So we focus on areas that are growing in population, even if it's at a slow rate, still there's some growth, right? That's typically a good sign. That's also a good sign in terms of workforce, right? So that's one thing that we'll look at, that's going to tell us if it's generally a strong market that may sustain growth in the future, even through a recession with some like lower demand. Another thing that we're looking at too, and this is not the case in Joshua Tree, again, because it's such a unique market, but in most places, you can also run your model as a long-term rental, right? In a very worst case scenario, maybe you're not seeing the demand that you expected. Maybe regulations changed. Can you put a renter in there? Get someone signed up on a lease, and can you still cover your mortgage? That's a really great way to hedge against that risk as well. But before you go there, I think there's so many strategies to implement to optimize your rental and really start to get it at competing at its best with all the other, especially in saturated markets. So a couple of things that we look at to try to hedge against things that we really can't control in the economy.
Yeah, and there's all kinds of strategies, Stefan, that people are doing right now, because we're seeing that right now. So a big kind of trend is people are removing their cleaning fees, and they're putting this in the headline for their short-term rental, right? So they say no cleaning fees in hopes that they're going to attract more people, right? So there's a lot of little things you could do on the macro level to your listing, changing some words around, maybe getting better photos, right? Improving the overall user experience at the property level. Then there's things you could do at the market level. There's things you could do to adjust your buy box to make sure that you're protected. But I think the biggest thing for people, Amanda touched on it, is having multiple exit strategies with your short-term rental. First one being, what other rental can I do? The next kind of profitable is a medium-term rental, right? Something for periods of 30 days, maybe traveling nurses, corporate housing, something like that. Airbnb, the actual website itself, now has an option for people to be able to rent out houses for the longer term, right? 28 days to 6 months. And so that's a really, really attractive strategy for a lot of short-term rental hosts. They're going the medium-term rental route, because then you could still keep your property on all the existing channels, Airbnb, Booking.com, VRBO. You're just getting much longer reservation as opposed to the 2 or 3 days. Now you're getting 30 days, maybe 40 days, 60 days, something like that.
So have you seen that grow, actually, that kind of market of the medium rentals? I have a friend in the New York City area who does some Airbnb, and I know he shared, like, he got this booking for, like something along the lines of 40 days that I thought was quite great, actually. And he felt like it was something new that he wouldn't have been able to, he wasn't seeing back in 20 prior to 2020, let's say. So have you seen that market actually establish itself on Airbnb or other websites?
Yeah, definitely. So even though we are in a vacation rental market, it's Joshua Tree, right? We're in a very heavy vacation rental market. I currently have a guest staying for 46 days right now. And they actually contacted us, and they said, hey, they're an amazing couple from LA. They're kind of freelancers, and they just have the ability to rent a house for a period of 30 days or more and live somewhere different. I got 2 other inquiries at another property for people, same thing, wanting to stay for 30 days or more. And those are inquiries that actually came to us. So pretty cool. You can actually adjust your parameters within these different channels. So within Airbnb, VRBO, Booking.com, you can set your profile so that you're essentially more open to accepting these longer stays, right? Or you can decide, hey, you know what? I don't want to accept longer stays at all. I'm just going to go go through with 28 days or less, right? You can change those parameters. So it's definitely changing. Like I said, I was actually contacted because I'm the one who manages our rentals. I've been contacted multiple times for people who want to stay. And so I like it as a short-term rental host because rather than having 15 different groups in there, maybe 30 to 35 people over those 15 different groups, I just have one person in there, one person in their family. And then rather than having 15 different cleanings and maybe have to worry about someone wanting to check in early and check out and someone breaking in, I just have to deal with one person in their family. So although our rates are lower because we discount our rates for longer term stays, our cash flow is about the same. It works out to about the same because there's just so much less use of the property. There's less maintenance, there's less repairs. So as a short-term rental host, I totally welcome the medium-term rentals too.
Right, right.
There
No,
was and I was going to share, there was an article that came out, and I don't remember the exact person who published, but I'll find out and send it to you. It was like a hospitality tourism article, and it showed that the biggest growth in demand for tourism was in longer stays, 30 days or more. So that was actually very surprising for me to read, to really understand how the market is changing and people's appetite for these longer stays. Maybe it's the remote work that kind of stuck around, right?
yeah,
So
that
this
sounds
is becoming a huge segment for growth in the tourism area. So if you can accommodate those guests, then I would absolutely recommend it. And this is a great strategy for people who have a property that are limited by HOAs or certain regulations. I have a friend who bought a property in Marina. Her HOA only allows 30 days minimum, and she was able to get in her first midterm rental at a very good rate, who stayed in there for, I think, 58 days. So it's a really fantastic strategy. It's slightly different, but generally speaking, it's the same approach, right? As far as underwriting experience, managing the guests as well.
right. Because now you can just get someone who just wants to work from home and stay there for 2 months or whatever, right? And that would just never happen before. So it's a totally different ballgame. And also from an appreciation standpoint, what I really like about what you mentioned as far as drive-to markets is actually from an appreciation standpoint, those are quite solid, if you will, in the current trend where there's like suburban trend and like people from metro areas moving out to surrounding other parts, be it as renters or even like buyers of those properties. So that's actually kind of being on the good side of this, what I think is like a significant trend right now, right? So because I personally feel that it's huge. I feel like it's almost as big as I would say like internationalization of labor in the 50s. And so that's kind of, I don't know, that's just my perspective. So I feel like that's actually a really great strategy in that sense. And so in the medium term rentals is probably just one added benefit to that. And so in terms of so another question, actually, we just got a question on the chat with regards to like acquisition price for the Palm Springs building. So was it like kind of an off-market property, or was it through a broker, or what was that experience there as far as acquiring it and price point and so forth?
Yeah, excuse me, we have a broker who brought us this off-market listing to our business partners, actually. And the business partners brought us into the deal. It was a $3 million purchase price. And this is our first commercial acquisition. It definitely won't be our last. But what we realized is, as David alluded to earlier, taking down a $3 million property versus a $500,000 property, we're just adding a few zeros, right? But the approach is the same, the same amount of diligence, thought, design, construction management, right? And you're just getting so much more value because of the economies of scale. But yeah, it was a $3 million purchase. We have another $1 million going into the renovation and setup. So it'll be like about $4 million in, all in.
Right. Wow, that's great. That's a great step forward. So how did you guys find like partners or investors for it? Like, is it a syndication or is it a joint venture, or what is your structure there?
Yeah, so for the actual structure of the partnership, it's a joint venture partnership we entered into with they were actually our former property managers. So we were doing a walkthrough of one of our Airbnbs, and they were just complimenting the design and kind of our vision for the property, and they thought it would align really well with this hotel. So that's how they brought us in. So that's the partnership side of the structure of things. And then in terms of the lending side, we raised the debt for that. So it's not an equity partnership that we raised for. We ended up raising the debt. You want to touch a little bit more on that?
Yeah. So we could have done a syndication for this deal if we wanted to. Frankly, we wanted to keep the equity in-house. So we had proposed to our partners to raise the debt through the use of OPM private lending, which is why we love this strategy, because as long as we're buying the property at the right price, we can raise the debt in the form of private lending, pay our lenders double-digit returns on that deal, and structure it so that we can finance, or we can actually account for that cost of money and that interest to those lenders, get to the point of completing construction, refinance, and then do payoffs. And that allows us to keep all of our equity in-house, but also creating value for our investors and for our lenders by getting them double-digit returns on their money. So we love the use of private money here. And it's also a lot easier to structure than a syndication. For those of you that have done syndications, you know how much paperwork it is and a lot more red tape. So we love using debt lending or private money lending for these types of deals.
And it was a strategy that we got so comfortable with in the single family residential space, flipping properties. So it was essentially the same thing, just for a commercial building. It's just a couple more, it was a comma, a couple more zeros, and that was it. But again, it's literally just the same exact method.
And so if you want to kind of explain a little more actually the strategy there, because is it like, why not go, let's say, to a typical like bridge financing or like asset-based lender and so forth for that deal? Like, was it that they would be more restrictive in terms of how you guys then structure your equity, or like other sort of the whole set of lender requirements? Or what is the reason to use private? Because private money usually here more on the equity side, right? So as far as the debt side, like what are some incentives to do that? I'm just trying to understand.
Oh yeah, this is where it gets good. This is where it gets good.
Well, actually, I will actually clarify and say that we used a bridge loan for about 72% of the purchase. And then we raised the rest through private money. So excuse me, in the beginning, we actually went for an SBA loan, which we were pre-approved for, but it would take so long to close that it wasn't in line with the seller's expectations. So we decided to close with the bridge loan at about 72% of the purchase price. And we put in some of our own, the team's cash into the deal. And then we decided to raise the construction and the holding costs through private money. And private money,
understood.
yeah. So it's a combination of both, but a bridge loan is still a lot more flexible than your conventional bank, right?
Got it. So you wanted to kind of raise, like have fewer equity, not split the deal as much, kind of have more bigger part of the deal and like increase like leverage essentially.
Exactly.
Through private money. Understood. Okay, Nelson, go ahead. I see Nelson.
Hey.
I have a question. So,
hey, Stefan. Hey, Amanda and David. Great to see you guys.
Good to see you.
Great to see you as well, Nelson.
Okay. All right. Hey, on the deal that you guys just mentioned, what was your I guess my first question is what's your turnaround time? Okay. And be able to, if you could walk through a timeline, that would be the first question. And my second question is, I was so excited to see you guys and Stefan, everybody, I forgot about it. So it'll come back to me.
No worries.
Yeah, no, timeline. So timeline for the project, we acquired it in July of last year. And we expected anywhere between a 6 and 8 month renovation process, right? So we closed on the property and we did a 12-month note with all of our lenders. And we took a few months to do some design work. We bought the property about 90% renovated. So think of it as drywall ready for final finishes, landscaping, hardscaping, and all of that. So about a 6 to 8 month renovation is what we had anticipated. We are about maybe 2 to 3 weeks out from finalizing construction, and then we'll move into the furniture, the staging, the full setup, and the operation part of it. So when it's all said and done, we're going to move into more permanent financing. So we're actually shopping with lenders now to go into a more permanent product, perhaps looking at SBA once more. So we're looking to get out of our existing loan and do all of our payoffs no later than July of this year. So a year turnaround to get everything up and running, but we should be in full swing by April, if all goes according to plan.
Yeah, and we got pretty lucky, Nelson. Then the reason why it took less than a year really for everything to come to fruition was because, like Amanda mentioned, we purchased the property 90% drywall ready. So the investor that we purchased the hotel from, he had purchased the hotel, I want to say maybe 2-3 years prior. And so he inherited a whole slew of mess. So he kind of did a lot of the heavy lifting with the mechanical, electrical, plumbing, right? All the permitting. So he was able to get all of that squared away and taken care of. So by the time we took over, we really just had to come in with our final design, final finishes, and put the Nopali touch on it to make it look really nice.
Okay. So then on the original loan, right, that you guys had, you said so the property, it took it a total of what, 7-8 months to be ready? Okay, so could you describe the note? Any mortgage payments being made? I mean, what was it, at refinance at the end, at maturity, everything would be paid interest at one shot. Can you describe that too?
Yeah, so our bridge loan, I believe we closed at 9.49%, which now that's really good. So we were able to lock that back in July. And we have interest only payments through this lender, which are very high on a $3 million purchase, 2.2 or $2.3 million loan, right? But this is where private money is so valuable, because as investors, as we're getting through this startup phase for the property, we can borrow private money for all of our holding costs. So we did that. So we borrowed money for construction, we borrowed money for interest payments, other holding costs, utilities, property tax. We factored all of that into our deal. And as we approach our permanent financing, as we approach the refinance, we are estimating that we'll be at around anywhere between a 67 and 70% loan to value. That's with all of the payoffs for our hard money, all of our private money, and all of the interest accrued. So we're looking to be in a really good position when it's all said and done.
And then when it comes to, you said SBA, you were going to use SBA to buy, and I'm sorry, I kind of came a little bit late. I'm over here in Puerto Rico. Right? What does that have to do with anything? Everything.
Taxes.
Taxes. Yeah. But so the SBA, this is a hotel, right? It was a hotel, a boutique hotel. Yeah, I remember. So you were going to use the SBA loan to purchase the boutique hotel?
That was our original plan, but the SBA process is very arduous and it takes long. Our seller wasn't willing to wait, so we closed with Bridge. However, now when we're looking at more permanent products, 25, 30-year term loans, we are looking at SBA again. And the value of SBA is, even though it's the most arduous process, they are by far the most favorable in terms of LTVs. Some go to 80 or 90% LTV, which is incredible. They also have generally more favorable rates. They typically go with, market rates, prime and that sort of thing, but they'll have very, very favorable rates. And they're also very flexible in terms of requirements. Most conventional lenders, for example, require 2-3 years of seasoning on a hotel before they give you even 50 to 60% leverage. So for SBA, they don't require any operational history for certain products that they offer. They'll go strictly off your projections. So for that reason, SBA is worth the headache. It's just so favorable in terms of LTVs, requirements, and interest rates, if you're trying to get into a property that really doesn't have a lot of operational history.
Okay. Looks like I guess we got to get a SBA person on as a podcast guest.
Yes.
That wouldn't be a bad idea. And how did you guys have to set yourselves up, I guess you could say, operationally, financially, to qualify for the bridge, the SBA? I mean, what did you guys do so they could say, okay, the golden feather falls on you?
You want to take that?
Yeah, you got
Yeah,
it.
yeah. So that's something that for sure crossed our minds. Like, how will we qualify for a commercial loan at this scale? And, there are a few things that play a role in a commercial loan, right? When we're talking about conventional lenders versus like a bridge loan, the bridge loans or hard money lenders tend to be a lot more flexible with requirements. Generally, they want you to either have some liquidity or enough assets to cover interest payments in case maybe, things didn't go according to plan, right? We will say our partners have really strong liquidity as well. So partnering with people who have strong liquidity or really, really large value in assets will help qualify for the loan. And even if that's just part of the team, right? The other thing that a lot of lenders want, especially in the conventional loan space, is experience. Everyone asks, what's your hotel experience? What's your experience managing and operating a hotel? And really, like, none of us have hotel experience going into this. We have very similar experience, right? Property management for short-term rental space, which it's very similar, but it's not quite the same. But because we went with a bridge loan first, we were able to kind of bypass that requirement. And now moving forward, we're looked at more favorably by more commercial lenders who now can look at us and say, we'll have this experience under our belt.
They did want to see commercial experience in general, and that's where your team comes in, right? Leveraging other people and their experiences. So our third business partner, Amanda's brother Oscar, comes from the commercial construction world, where he was a superintendent for one of the largest commercial construction companies when he was 25 years old, by age 25, right? So he's very sharp, very smart guy. I love Oscar. He's absolutely amazing. So he was like a golden child also to have on our team too, because that was very favorable in their eyes, the lender's eyes. They felt comfortable lending to us with having a key player on our team like Oscar.
Okay. All right. Well, thank you. Thank you.
You're so welcome.
You're so welcome. It's good to see you, Nelson.
Same here, guys. Same here. I'll be reaching out to you guys afterwards.
Sounds great, Nelson. Are there other questions that maybe you wanted to address?
Yeah, actually, yeah. So we do have a couple. So so Tyler is asking, so are your investors the partners you have in the deal or external lending for your single family homes?
So to be clear, are your investors the partners you have in the deal? Oh, got it. Are you talking about our private money lenders, Tyler? Yes. Okay, got it. So yeah, so we right now, as far as ownership goes, it's just our team with the two partners that we talked about. And then all of our private money lenders they're coming in just as lenders, as debt on the property. So when we work with private money lenders, we'll do a few things. We'll record a promissory note, we'll record a deed of trust or a mortgage document against the property, and then we'll also add them to insurance. That's a very common process for private money lending, and they'll pretty much just exist as a additional debt on the property or a lien against the property when you close. So I don't know if that answers your question, but if you want to ask a clarifying question, you can in the chat.
Yeah, because he said, or external lending for your single family homes. So hopefully we answered your question.
Yeah, hopefully
Tyler.
that addressed it, Tyler. If not, feel free to just ask in the chat.
So you guys said, so promissory note, mortgage also, and insurance. Is that it? Yeah.
Yeah, that's the most common when you're recording private money loans in the form of debt for a property.
What kind of insurance is used there, actually? Just curious.
So any homeowner insurance policy that applies to the property, what you'll do is you'll add a private money lender as a loss payee or a beneficiary. So whether it's a landlord policy, a vacant dwelling policy,
builder's
risk, you're going to add that lender as a loss payee or a beneficiary, just in case some sort of like hazardous event happened, right?
Right. So, okay. And Michael is asking like what rates they are. And I'm actually curious, like what's your source for those? Like, how do you find them? Is it networking events or are there any online I'm not sure if you're using any of the online kind of systems.
Yeah.
We could talk about this.
Yeah, we could talk about this at length. So literally, we were actually taught. Amanda ended up joining a Raising Private Money coaching program by Amy Majuri really early on in our investing career. Shout out to Amy, she's absolutely incredible. So we were actually we were taught from the very beginning that literally anyone and everyone can be a private money lender. And the really unique thing about Amy's program and Amy's approach is that typically when newer investors start out and they're looking to raise capital, they go to their network, and the first people in their network is often their family and friends, right? Where we actually did it a little bit backwards. So we implemented systems to look for private money lenders from literally anyone and everyone: LinkedIn friends, people we talked to, Uber drivers, people that we went to high school with, people that we went to college with, right? The key thing for us is just talking to anyone and everyone about what we do and letting them know that we help other people earn double-digit returns backed by real estate. That's been really, really key for us, because when you start talking about, double-digit return, what'd you say, right? People start to perk up a little bit, because where are you getting double-digit returns from? So really, networking is huge for us. We absolutely love networking. We love talking to people who are interested in real estate. We love letting people know that we earn double-digit returns backed by real estate. We also have that line in our email tagline. We have it like in our Instagram bio headlines. We have a t-shirt with that on the back of our t-shirt, so that in hopes when we wear it, people stop us and they ask us, hey, what do you mean you help other people earn double-digit returns backed by real estate? So really, it's just hitting our network hard. We have a couple of systems that we implement regularly: newsletters, text message campaigns, sending messages out to individuals through social media, just letting them know, again, we help other people earn double-digit returns backed by real estate.
This type of lending is rapport-based lending. It is so critical that your first goal with any prospective private money lender is to establish a relationship, build trust, show your credibility, so that you can gain that momentum with that lender moving forward. That is the absolute fundamental first step before you go into any sort of deal with a private money lender. So this is rapport-based lending. It is important that even if it's someone that you're meeting for the first time, that you establish that relationship first before you get into a lending relationship.
Mm-hmm. And in terms of, what kind of rates can one be looking at, let's say right now in private money?
It varies widely. We offer between 10 and 12% annualized. Sometimes it's less, sometimes it's more. It's very much deal specific, but typically you'll see in the double-digit range or higher.
Mm-hmm. And so another question from Tyler: do you guys ever structure your lending as equity or just strictly debt? So asking because my first short-term rental in Denver, I partnered with a financial partner who brought the capital and borrowing capacity only, and I brought all operations. Curious if structuring it as debt has more benefits.
Yeah, so this is, congratulations on your first short-term rental, by the way. You can structure it in any way you want. It has to make sense for your deal. So you, as the sponsor of the deal, you need to figure out, is it going to be more profitable for me to give out equity? If so, how much? Or is it going to be more profitable for me to do a note at 10%, 11%, right? It's really going to come down to your deal. And you also have to keep in mind, partnering with someone is very different from lending, right? When you have an equity partnership, it's like a marriage, right? You have very different expectations. You have more involvement from that partnership. So that's something to consider as well. Private money lenders are generally silent partners in that they lend the money and we perform on the note, but there's no involvement for them. So that's one of the things that I would start with, is what involvement do you want from this partner? That being said, we have had equity partnerships where instead of doing a private money loan, we will give them, for example, 50% of profit share or cash flow of the property, right? So if they make a certain investment, we agree on a percentage of cash flow. We have some sort of I should say maturity on that agreement. That's another way to structure it as well. So it's really going to depend on your deal numbers and what involvement you want from that partner.
Right. And that's something that we talk to a lot of short-term rental partnership or short-term people who are interested in short-term rental partnerships is designating the two, right? You can partner on the actual house, or you can just partner on the actual short-term rental business and do something like a profit share where you split the cash flow, but you are the sole owner of the property itself, right? And that's the really the powerful thing about short-term rentals, like you mentioned in the very beginning. It's that beautiful combination of real estate, but also like a legitimate cash flowing business as well.
Mhm. And in terms of like your bridge lender, let's say that you mentioned, like, so do you want to, is that like one of the asset-based lenders or more like a commercial bridge? Is that, you know, just curious if that's like a favorable rate one that, you know, we should know about.
Yeah. Well, so typically hard money lenders are going to be asset-based lenders, right? They're going to look at the strength of the deal. They're going to generally look at some basic, basic strengths for the actual borrower, but it's mostly relying on the deal itself. What is the acquisition price? Like, what is the renovation amount? For example, what is the exit price, right? How will the borrower repay this bridge loan? So the hard money, I think, is a really great flexible way to get into a property an investment property that is strictly based on the asset itself, on the projected performance on of that property. But yeah, all hard money lenders are asset based, and there's just some very basic but flexible requirements as a borrower to be able to get into a deal. I hope that answered your question.
So, well, we got another question actually from Tyler where he's asking, okay, how is the debt financing structure? Do they basically just provide the down payment as a loan and then expect a return over a specific time period? And is their return usually dependent on a refinance? Trying to figure out how they would get their return.
Yeah, excellent question.
That's for hard, just to clarify, that's for hard money, right, Tyler?
Are you talking about hard money or private money, Tyler?
Looks like the private.
Private money.
Okay.
Yes. Yeah. So this question comes up a lot, and I'm going to tell you that it's highly variable, right? In private money, everything is negotiable. You can come to any agreement with your private money lender. It just has to be valuable for both parties. But generally speaking, when you go to acquire a property, when you underwrite your deal, you can borrow 100% of the funds that you need for your deal. When I say 100%, I'm talking about your down payment, your holding costs, your closing costs, your interest payments,
escrow fees,
escrow. You can borrow as much as you want from your private money lender as long as the deal checks out and it makes sense. So in most cases, the benefit of private money lending is we don't do interest payments, monthly interest payments. We pretty much defer all of the interest till the sale or the refinance. So that allows us to be more flexible and not have to rely on any income on the property so that we can get it to the level of renovation that we need. In some other cases, you're going to have other types of properties where maybe you can't rely on a refinance, or maybe you can't rely on some other exit strategies. In that case, you get a little bit more creative with how you're paying your private money lender. Maybe you're doing an interest payment. Maybe that's cash flow. Maybe you have a 3-year term instead of a 1-year term, right? So you have to look at the deal, see where the value is and how you can extract from that value to pay back your private money lender. Maybe it's cash flow from the Airbnb, right? Maybe it's a sale in 5 years or a refinance in 5 years. Just look at where you can extract value, and you can structure your repayment to your lender that way.
Right. Or maybe it's both. Maybe you pay them from the cash flow for a certain number of time, and then upon refinance, you pay them the rest. So you could get as creative as you want. And the cool thing is all of that gets memorialized in the promissory note. So people know exactly what our private money lenders know exactly what they're entering into with us.
Mm-hmm. That makes sense. And it's kind of interesting, as you mentioned, they're pretty much silent partners in that case. They don't have to kind of have all those conversations about the deal and so on and so forth. You just kind of send your payments and that's it. So in terms of, so any other questions, guys, before we're a bit over time now. So if I'm not sure if any last questions, perhaps. Okay, I guess we covered like a good amount of items here. So that was great. Like, so before we wrap up, like, what is the best way to reach to you, David and Amanda, and like, what are anything you want to share basically with our audience before we close for today?
Yeah, definitely. So Instagram is the best way to get in contact with us. I'm at David J. Fornelli, Fornelli.
I'm at _ Amanda Fornelli _ on Instagram.
And then our company, our fix and flip company is Nopali Properties. Again, on Instagram at Nopali, NOPALI _ properties. And then we also have a website. You can find us on Google and all the other major channels by entering in Nopali Properties.
Yeah, and last plug that I want to share is we're moving towards a short-term rental consulting type of service as well. It's still in the very early stages, but I do want to throw it out there. If anyone is interested for down the line, we can potentially chat. But pretty much what we're doing is we're offering a 100% turnkey done for you service for short-term rentals. So you're going to acquire a property and we'll take it to the finish line and even offer to manage the property in high performing markets in the Western United States. So this is ideal for people that maybe have the capital and the interest to get into a property, but do not have the time or the desire to design it, furnish it, manage it, guest communication, right? This is a way to get into this asset class without giving up your freedom of time. So if you're interested in that, that business is called Turnkey by Nopali, and you'll also be able to find out more information by reaching out to us directly. And we'll also be marketing that business very, very soon.
That's awesome. Thank you so much. And thanks for sharing all your knowledge with us here tonight. It was a pleasure to have you. And with that, I wish you good night, and to everyone as well. Thanks, guys.
Thank you so much.
Thank you so much for having us.
We appreciate it.
Stefan, it was great for you to have him on. And David and Amanda, it was great to see you guys again.
Good
Thanks,
to see you
Nelson.
too,
Good to see you,
Nelson.
Nelson. I hope you're having a good time in Puerto Rico.
Only the best. Only the best. I can't wait to have you guys over. I'm waiting on Stefan. It's not cold enough in New York for him to come down.
We'll have to plan a trip out there and visit you.
Yeah.
Okay. All right.
Thank you so much.
Yeah. Thank you, Stefan. Thank you so much. It's been an absolute pleasure.
Thanks, guys. Okay.
All right.
Goodbye.
Take care.